Hello and welcome. You're watching KYC. I'm Hersh Sayta. With me is Mahima Vajrajani. And do you want to play FMCG? And do you want to play FMCG in a more interesting fashion at probably a better multiple? That's really the question we are asking today from the company that we've called. We're going to be speaking with an AGI Greenpac. And of course, as always, before we speak, we try to give you insights into what we want to know from the company. So let me start off with that. In FY25, we saw cash flow from operations versus the EBITDA number come off. That's never a healthy sign, but FY24 and FY23, we were fairly okay on that count. So what happens when operating cash flow falls? There's an increase in receivables or there's a reduction in payables. Well, both of that have happened. The management has given guidance that will unwind in FY26. I will want to understand whether that unwind has actually happened. So that's my first big question, because cash flow is obviously king and we want to know whether cash flow has stabilized or not. Second, capacity debottlenecking. Now, the company operates at a 95% capacity utilization. It's been doing so last year. It tried making an acquisition. That acquisition clearly didn't work out. Therefore, they are now looking for organic options. That organic option doesn't come in or doesn't kick in till FY28. So what are they going to do now? They're going to do some debottlenecking. What's the visibility like and what's the top line impact like? That's what I want to know. But that's FY26. I also want to understand FY27. What will that number be and where should we expect growth to come in at? Now, point number 4 is Capex. They're doing a large Capex, 1700 crore. A different product line in aluminium cans is what they will do. Along with it, they will also add a 25% to their glass bottling plant. All of those to add up, obviously, in terms of numbers going into FY28. So I want to understand what the Capex is going to be like, whether this is the number that we can expect, how do you fund it, and what is therefore the overall picture with regard to Capex as well as returns, because return on equity will fall because you will have such a large investment upfronted. Now, the next point is I want to understand what the confidence is of the management in EBITDA per ton. They say that is the better metric than margins to look at. EBITDA per ton, they are saying, will go up by approximately 6% annually. If that were to be the case, what is the visibility like? How many years will it continue to go up for? And what is the comfort like on that number? Raw material price pass through. They do soda ash in terms of raw material, and then of course plastic has plenty of raw materials as well. So glass has soda ash, plastic has plenty of raw materials as well. All of that combined, they claim that they pass it through to customers. We will clarify that and we will also understand what the comfort is with regard to that. Last piece, they are going global and they're going global in a big fashion. What does that mean? Because in today's dynamic global environment, it's a difficult thing to do, from going domestic to looking global. Can they overcome challenges? How are they standing out in the global marketplace? All of that is what I'd want to know with regard to an AGI Greenpac. Mahima, you want to start off with about the company?
Sure. So, you know, as Hersh rightly mentioned, if you want to play FMCG from a backward integration perspective, then this stock you must keep your eye on. It's India's largest container glass manufacturer and packaging leader, focusing now more on eco-friendly packaging. It's B2B focused, serving 500 major plus clients across industry. It's expanding rapidly into premium and eco-friendly packaging, as I mentioned earlier. New entry, the aluminum cans that Hersh was talking about, is something that's going to, you know, further diversify their growth going forward. So that's a new one on the board for them. In terms of products and brands, basically it's in partnership with 500 institutional clients. The different brands that it has under its umbrella, the first one is AGI Glasspack, that basically makes your glass containers, glass packaging solution bottles for roughly 1.5 ml to almost 6 liters, so that it's that wider range. In terms of glass bottles, this is generally used in your cosmetics, perfumes, beverages, FMCG, chemicals as well as pharmaceuticals, but majority of their packaging goes to FMCG, around 6 to 10% goes to pharma and chemicals. Customization is available with colors, labels, prints, etc. So that's something that they give to the brands. The next one is AGI Plastic, which is another brand which focuses on PET bottles and packaging. So it makes your PET bottles, your HTP, your PP bottles as well. Basically, it's used for soft drinks, your water, edible oil, personal care sectors as well. So again, another FMCG theme to play with. The next one is AGI Closers. Now this is an interesting one because they make anti-counterfeiting security caps, and this is generally used in your alcohol bottles. So and this they customize with holograms as well as RFID. Plus they have high quality resistant security caps. So again, highly used in the alcohol industry. The cutting edge technology also helps them deliver the best in class when it comes to these particular caps, and it also has security features such as safetying, tamper evident seals, unique identifiers, and product authentication as well. The new business that we've been talking about is the aluminum cans, where it's going to do a 700 crore capex, and this will be for beverages, of course, and this will of course expand their base overall in terms of clientele and also cater to the existing F&B clients that it has. In terms of where does it manufacture, it's got around 7 plants in India, in Telangana, Uttarakhand as well as Karnataka. In terms of the overall production capacity, that's around 2,000 glass in terms of tons, and PET bottles, that's around 11,982 tons. And lastly, who does it sell to? As Hersh mentioned earlier, they are planning to go big way in terms of global, but right now the breakup is around 95% in terms of domestic sales and in terms of market distribution, and 5% it comes from the export. So this is the entire whole and soul of the company as and where it stands right now.
Well, yes, so thank you for that, Mahima. But so 5, can we have that graph again, please? So 5 and 95, this might likely change. The goal is to get this to 15 in the short term, 15, 85, and thereafter go from there. Really, that's the goal. But I don't know if things have changed because globally the picture looks quite different now. So, so again, something to keep in mind. The other piece that maybe we've not put in here is the fact that the top 10 clientele contribute over 50% of the top line of this company. So that is a key risk. You have 50% of your revenue coming in from the top 10 clientele despite having 500 plus clients. What's the risk like and how long are the contracts? That's the other piece I'd want to understand. But yes, that's broadly the case, and we'll speak with Sandeep Sikka, who's the Group CFO at AGI Greenpac, in a short while. Let me start off with the metrics without delay. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, the shareholding, the street cred. Thereafter, we look at outlook and return ratios. So we'll outlook and valuations, I beg your pardon. So we'll look at all 8 of those metrics and we'll give you a deep dive on each of those. Let me start off, or rather I'll allow Mahima to start with the income statement.
Sure. So in terms of the overall performance when it comes to the P&L statement, the metrics are looking very strong in terms of the overall revenue growth. It's grown at a CAGR of 21%, but something that I found interesting here was that as of FY22, it stood at around 1,400 odd crores, which has gone to 2,500 odd crores in FY25. But from FY23 to 24, the growth has not been much, from a 2,200 crores to a 2,500 crores in 3 odd years. So that's something to keep in mind. Then there's EBITDA, which is of course grown at a CAGR of 32% in the past 3 odd years, which stood at around 265 crores in FY22 to almost 600 crores in more than 600 crores in FY25. So a good growth there for sure. Margins are at the highest point as of FY25. That's interesting because at 24%, the guided range, if I'm not wrong, is around 22 to 25 odd percent.
That is correct.
They've done 24%. So we'll have to figure out as to what is the margin trajectory going forward. Will they be able to sustain that 24% mark, or will that be at the lower end of the band? The last one, that is net profit, well, 3-year CAGR has been 19%, so a good growth there as well. But like in the case of revenue, here also, as compared to last 3 odd years, from a 260 odd crore profits, it's grown to only around 320 odd crores in terms of profits. So that's something to keep an eye out for. In terms of the Q1 FY26 performance, well, revenue saw a growth of 22 odd percent. YOY basis, EBITDA saw a growth of around 4 odd percent. Margins, of course, have taken a hit, and net profit has seen a growth of around 6 odd percent. So that's with regards to where the Q1 FY26 performance stands, Hersh.
Well, yes, let's quickly look at the margin trajectory as well. FY22 to FY25, that's on a positive trajectory. So you're largely looking at positive metrics coming through. Q1 was slightly softer, but the markets really brushed that number off and has moved on with it. Let's look at the balance sheet now. You look at the overall book value, it's around 2100 crore. The market cap is around 6,000 crore, so 3 times book is what this one trades at. You have borrowings of around 550 crore. The positive here is borrowings are on a reducing trajectory, but with the kind of capex that is being planned, I want to understand whether there is a risk to this number, because at 550 crore, you're already looking at a 1:4 book. This could well go up, and hence we've been cautious about the balance sheet. We've given this a neutral where the balance sheet is concerned. What you also want to note is the cash and bank balance, 365 crore for a balance sheet size of 2,000 crore is no mean feat. It's a 15% of the balance sheet sitting in cash. So that's another key positive. So frankly, more positives than negatives. The net debt is also extremely low. And when you're looking at the overall picture, you're looking at 900 crore of cash, but you still have 800 crore to get funded. And therefore, we've just been a little bit cautious here for the moment. We've given this a neutral, but nonetheless, there's a positive bias where the balance sheet is concerned. There's no doubt about that in our minds. Let's look at cash flow as well. And Mahima, I'll tackle cash flow. In terms of the cash flow number, if you're looking at the way in which it's gone, you look at the EBITDA number and you look at the operating cash flow number. Largely, the CFO to EBITDA has been over 100, which is, positive. There's absolutely no question about it. The only possible pain point here is in FY25, when you had 65 crore of additional receivables and 62 crore of lower payables, both of those. Now, management attributed that to the fact that there's going to be a lead and lag, obviously, and that just happened to be at the year end. And therefore, you saw that differential on the financials. Otherwise, they're expecting an improvement to that number. Of course, the 204 net cash flow is largely because they'll continue to make investments in terms of Capex. So I wouldn't read too much into that. But the CFO number, obviously, standing large. But return ratios, Mahima.
Right, so return ratio has been on an upward trajectory. If we take a look at the ROE number, from an 8% in FY21, it's improved to almost 20%, and that's a huge improvement in terms of the return ratio. So considering that it's been improving, but whether it's sustainable or not is a question, and that's why I think we've taken a conservative approach here and given it a neutral rating. So that's the only reason I think why we've given it a neutral rating.
Yeah, that and the Capex, right?
The Capex that they're doing, exactly.
Once Capex starts to come in, you'll see the return ratios also come under some bit of pressure in the near term.
Correct.
I want to understand where that goes, how much does that shrink, and how much can that sustain.
Correct.
Will really be the question, which is exactly what Mahima said. Now, let me talk a little bit about shareholding. Promoter holding at 60%, FI is at around 7.5%, DI is at around 1.5%, public at around 30%. It looks like a decent set of shareholders. Promoters holding a decent stake. We've given this a clear thumbs up. Street cred, Mahima.
Right, so street cred is very interesting. In the past 1 year, the stock has not done much. I mean, it's seen a growth of 6% 1 month, the stock has seen a growth more than that of 1 year. That's up around 9%. 6 months and YTD returns are absolutely negative, 24% down YTD. But 5 years, it's been a multi-bagger, a huge multi-bagger now, where 15 times returns to its investor. So considering just the near-term performance, because the stock has been under pressure, we've given it a neutral rating. But overall, 5 years, it's been a multi-bagger.
And outlook as well, Mahima?
Right. So outlook also looks, very promising. I mean, if we take a look at the kind of guidance that the company has given, interesting. Capacity utilizations will be beyond that 95% is what the company is aiming at. FY26 growth should be anywhere between 8 to 10% In terms of the margin guidance, the range that they've given is between 22 to 25%. 700 crore capex on the card is something that the management has guided for, and that's the main peg of the conversation that we're going to have with the management. Whether how will this be funded? Any fundraising on the cards that they're looking at? And in terms of the aluminum can project, they're focusing on 1,000 crore in UP. That's a very interesting aspect, another aspect to ask the management about. And lastly, in terms of capacity, they want to reach 1.6 billion cans per year by FY30. So that's something that the management has as an aim from a longer term perspective. So thumbs up, of course, when it comes to the overall outlook.
Perfect. Now I'll talk valuations. So the revenue multiple in terms of growth versus FY25 I've taken at 10%. Some numbers on your screen on the back of that. The margins I've taken conservatively rather than 25, I've taken 23%. Therefore, arriving at an EBITDA of 640 crore, providing for a depreciation of around 200 crore, including interest costs getting knocked off by other income, and therefore arriving at a net profit of around 330 crore, therefore arriving at a price to earnings multiple of around 16.5 times, which is largely in line with the 5-year P of 17 times. Whether there's an upside surprise to that or not, we'll speak with management on, and maybe that's for you to determine as well. Let's quickly look at the rating parameters. Let's squeeze it all in together. Those are your first 4 metrics, and those are last 4. What stands out for me in this final rating, while it's 5.5 on 8, there is no thumbs down. That's what really stands out for me. So AGI Greenpac, let's speak with the management. Sandeep Sikka, Group CFO, AGI Greenpac, joining us at this hour. Sir, first off, good morning, welcome. I want to start off by understanding from you, this Capex of 1,700 crore, how much of that gets funded through internal accruals? How much of that gets funded to debt? Where does the debt number look like at the end of FY27? What's the picture like? Give us that.
So we feel that around 60% of this total capex will take debt, and 40% will use the internal accruals. The company may also like to raise some equity in the interim, more nearing to the the launch of the production, commercial operation production. If you see, these are 2 investments. One is on the expansion of glass. By investing 700 crores, we are going to expand the capacity by around 25%. And our investments into aluminium can is very strategic, given the fact that the high growth element in the liquid packaging market is the aluminium can right now. As the GDP per capita is rising, the demand for the aluminium cans in any of the country in the past, you can track that it increases substantially. And this is our foot in the door, so that this is, a very strategic move, which will have a long-term growth impact on us for ranging around 10 to 15 years.
Sikka, hi. Mahima also joining in. Just want to get a sense. You said 50% of it will be funded by debt. Just want to get a sense that you're already sitting on a debt of around 550 odd crores. Considering the entire 1,700 crore capex, around 850 crores is another debt that will be added to your balance sheet. Just want to get a sense of the debt trajectory. And the second part of it, any fundraising on the cards that you're seeing? Because, 850 crore, another 850 crore will be a big amount to look at.
So if you see, our net debt is not actually 500, it's around 200 crores. As we have cash in hand exceeding 300 crores. Part of the debt has already been prepaid, amounting to around 200 crores in the month of July. And when I said 50, it's 60, it's not 50, I spoke 60. So basically 1,000 crore of debt. So if you see our existing run rate of EBITDA ranging 650 crore to 700 crores around. So we are pretty comfortable, raising this debt. And if required, as I told, we are very comfortable raising equity also. There is very deep interest in the investors. And we have a good response there also, but we'll wait and time it out.
Got it. Sorry. So you said, sorry, I'm going off script right now. You said you're open to raising equity at these valuations, sir.
I said we'll time it out at an appropriate manner. Right now, the biggest issue was that market was looking at where the growth is coming from, given the fact that we are at 95% capacity utilization. Yes. We have given a path now. Our company has taken a robust path to grow, and we feel that we should continue with all these investments. We should have a sustained growth of 15 to almost 20% year on year once these projects come on stream.
So 15 to 20% YOY, which is that you double your top line every 4 years, but give us the outlook for FY26, which is 8 to 10% growth is what you've given. Is there an upside possibility to that? And what about FY27? You've got better visibility of the debottlenecking you're doing now. What is that top line number going to grow by in FY 26-27? Thereafter, every 4 years you double. So that visibility we have.
So right now, if you see, we have given a guidance 8 to 10% growth over the last year number on a full year basis, and this is based on the fact that we are at almost 95% capacity utilization. But we are making certain investments within the existing plants, like we are adding more lines, so that we can value add the product, we can change the product mix to higher product mix, so which also leads to a higher margin on the bottom line. Also, we had made investments into one very key strategic product, which is our security caps and closure, which is an anti-counterfeit cap for the liquor. The product is very good and it gives almost 35% plus margin. Value-added product, it's a patented product. We are making investments. So these are the offshoots wherein we are investing, so that at least till 2027, we are able to maintain 10% growth year on year.
Okay, Mr. Sikka, just want to get a sense in terms of your margins. You've given a guided range of 22 to 25%. FY25 ended at the highest level, that's 24%. What's the aim for FY26 and 27, considering everything that you're doing? Will it be at the higher end of that range, or what's the sense there?
So I think I'll keep the range in a similar manner, but as you unlock the capacity, the entire contribution gets added to the EBITDA, given the fact that the fixed cost almost remains the same. So if we are able to unlock our capacities further, go beyond 95%, touching 100%, definitely I feel 0.5% to 1% expansion can happen over 25 numbers.
Oh, wow. Okay. So another 0.5 to 1% over 25. Sir, two questions wrapped into one. I want to understand, firstly, with regard to your raw material pass-through, how quickly does that happen? Your top 10 clients account for over 50% of top line. Is that at all a risk? And how long are these contracts in terms of duration? What's the visibility like?
So if you see, our relationship with our customers is now running into 3-4 decades, and many of them are multinational clients. 65% of our portfolio, we have a formula wherein there is a pass on and a pass off. And generally, this pass on pass off is relating to certain elements like fuel prices, soda ash prices, and few other elements. This gets adjusted in a span of quarter or 2 quarters, how the whole cycle is. But if you see in the past, we have been fairly successful in this, and we are running this model for almost now 5 years with our customers.
Mr. Sikka, I just want to get a sense of you expanding into the global markets as well. What's the kind of aim? Right now your exports stand around 5% odd. Where will this be 3 years down the line? First question, and what are the risks that you're seeing when it comes to global expansion? What's the competition aspect as well there?
So if you see, we made investments into a very unique product portfolio, which we call as specialty glass. And this glass goes into perfumery, cosmetics, various high-end applications. We have been through this cycle for almost now 2 years. The product is almost nearing stabilization. And here the competition is with the various global players. And this is the product actually which we can compete. And the strategy and the plan is that once this whole product gets stabilized in terms of configuration, product quality, etc., because it takes time to deal with most of the global clients. They have their own procedures to pass the products. So then the plan is that we will set up more furnaces, maybe port-based. So wherein the whole focus will be export into cosmetics, perfumery, and other high-end applications.
So how long is the runway for growth looking like? Around 15 to 20% is what you're gunning to grow at FY28 onwards. How long is the growth runway on the current Capex that you're doing? Give us that perspective.
So if you see, most of the investments which we are doing, they should yield us minimum 1 to 1.1 or 1.2 times the sale. So the margin expansion will also happen in terms of absolute number. So with all the profits which we are going to generate, definitely, we are going to look for other packaging segments. Like I spoke about, the specialty expansion into the more specialty, which is a high-end specialty glass, which is a high-end glass. So similar more initiatives will be done, because when you are raising, your production, your abilities to service your customer in terms of providing solutions, So we'll definitely keep the momentum on. And this is a vision right now, which we are giving for 5 years. We should be able to grow by almost 2.5 times of what we are right now.
Excellent. Sir, last off, on the return ratio count, what should that ROE, ROC number be? What are you really penciling in?
Right now, if you see, we are at an ROC of around 18 to 20%.
Yes.
Most of the projects which we generally do, which our board approves, are in a similar range, ranging around 16 to 20%. But some of the moves are strategic, like aluminium cans and all those things. It's a first footstep. We have to see the full cycle, and I think the one full cycle after 5, 6 years, even ROCs on almost all the elements wherein we are investing should yield us in a similar, 18 to 20, 21% range.
Excellent. Thank you so much, Mr. Sikka. We're out of time, unfortunately. This is an extremely interesting conversation that I've had. Thank you so much for coming and speaking with us. And viewers, completely out of time on this edition of KYC. Thanks so much for tuning in. From Mahima, myself, everyone who puts the show together. Grateful for every viewer that's watching us.